very good evening. You're watching The Money Show, a part of ET Now's Rise with India Prime Time segment. I'm Mubina Kapasi. And yes, today was a day of recovery coming in on Dalal Street. We had green on the screen, and let's hope for some more stability on the financial markets from here on. But here's what we're going to discuss today on the show. Remember, Friday we saw the RBI coming out with a whole host of announcements, while for all of the borrowers, the ones that are paying down their home loan, car loan, EMIs, the one pleasant surprise was, of course, the moratorium. However, there were other announcements as well, starting off first, obviously, with the repo rate cut, 75 basis points, and there was margining of the liquidity adjustment facility, which basically means even the reverse repo was, of course, cut, but by a larger quantum, 90 basis points. Apart from that, there were more liquidity infusing measures announced, something called as a targeted LTRO, which means, to put it very simply for our viewers, the RBI gave more money to the banks at a lower interest rate, and so it said, look, here you go, now take this money and invest it in certain kinds of high-graded, high-quality corporate bonds. So interesting announcements, maybe a bit complicated for, a layperson to understand, somebody not well-versed in finance. That's what we on The Money Show are here for, to help simplify all of those announcements and help you understand what exactly do all of these announcements mean for your money. I have with me Mr. Lovaii, Navlakhi, MD and CEO of International Money Matters. Mr. Navlakhi, great to have you back with us on The Money Show. Let's take all of these announcements one by one. Now, we always say that debt funds, the universe of debt funds has an impact on the NAVs, on the returns it can give all of our investors, based on what the RBI announces. So let's take the first part of the announcement. That's a 75 basis points repo rate cut, a cut in interest rates. Now, for the borrowers, it's fairly simple to understand that, okay, look, you know what, in the future, if I take a loan, the interest rate will probably be lower. But for those who are investors, for those, especially in the debt fund market investors, what does it mean for them, Mr. Navlakhi?
Thank you, Mubina, for having me. It's a pleasure to be on the show as usual. The RBI's announcements, while, on the one side, as you mentioned, there's a positive for the borrowers that they will get a lower interest rates when they borrow money. It also means that the deposit rates will come down. So those who are putting their money in the bank, whether it's in savings bank, it's in fixed deposits of the bank itself, rates are likely to come down. So that's one aspect. For those who have already invested in debt mutual funds, depending on, of course, now it starts getting a bit complicated, depending on where those debt funds have invested, what is the tenure of the investment, etc. It will be different for different investors. So whether they are going to make an extra return on that particular investment or not is really dependent on the type of fund that they have invested in. What typically happens when interest rates fall, the price of the bonds that are in the market will automatically go up. And as a result, those of the investors who were already in debt funds before the RBI announcement will suddenly find that their NAVs have shot up and their returns on their investment has gone up quite considerably. So as a result, what has happened is, if you looked at 1 week returns on debt mutual funds as of last week, some of those returns were, numbers which you would normally get in equity markets. They looked like 80% per annum, 100% per annum, which effectively means that you got, little over 1.5 to 2% return in just 1 week on a debt mutual fund. So that's the first impact, Mubina.
Okay. All right. Now, of course, the other bit is also with respect to targeted LTROs. Like I said, it basically means the RBI has given money to, essentially the banks and said, look, here you go, invested in corporate bonds, giving them more liquidity. Now, of course, for us as a retail investor, one may think, okay, why does that make a difference to me? But again, we as well can invest in the corporate bond market in the form of the corporate bond funds. So how does this targeted LTRO aid, corporate bond funds, if it does aid it in the first place?
One of the things that had happened before this targeted LTRO was the fact that liquid funds and short-term funds had actually lost their values a bit during the previous week. And that was as a result of a lot of outflows that happened from the liquid funds, from FIIs as well. And as a result, some of those funds were negative. So what was happening is that really short-term investments for mutual fund investors was also turning to be negative, and people were wondering, that while in equity they had taken a big haircut, and they thought they were in safe field of the liquid funds. Suddenly, they found that their liquid fund NAVs were also turning negative. So this was because some of these overnight and liquid funds and short-term funds require to change their valuation on a mark-to-market basis. They do have some investments in debt instruments, which would vary and would sort of lose value because the yields have gone up. So the result of this targeted LTRO meant that the government, the RBI, sorry, was providing money in the short term to these banks and saying use this money. So there is liquidity first. So the first reaction of that was liquid funds started becoming positive, and they have also given a good return in the last week. But at the same time, they said use this money to buy corporate debt and good quality paper. As a result, you suddenly found that some of those type of instruments which were struggling to raise money got money from the RBI itself through these banks, and as a result, some of the corporate bond yields also fell. So you found a two-way sort of benefit, both in the short term and in the long term. It normally does not happen simultaneously, but it was just sheer liquidity which was causing the problem. And RBI decided that we better give them liquidity so that this problem could get resolved.
Okay, understood. So very simply explain it to us, Mr. Navlakhi. Now we are expecting that, in the market, the RBI as well said that, what, I'm going to keep the stance as accommodative, which means there is a possibility that going forward as well, we may see interest rates go down further. So interest rates are going to be low. In such a scenario, Mr. Navlakhi, within the entire debt mutual fund umbrella, there are several categories, right? We spoke about corporate bond funds, but there's also, of course, based on durations. There's those ultra short-term funds, there are liquid funds, and then there are these long duration funds as well. Which one and how would they stand to benefit? Explain that correlation between interest rates, bond prices, and consequently mutual fund values.
Yeah, so before I get into the implication on the prices, I think the most important thing that one must recognize that when one invests in a debt mutual fund, the primary objective is first safety. That I don't want a risk of having a default in the debt mutual fund or a reason why the interest rates that I expected are not there. So safety becomes an important factor. The other thing that is important to also match is the time horizon for which you are investing and the appropriate debt fund for that purpose. Because if you are investing for just emergency money, let's say in this situation, you want to make sure that you keep some money which is accessible at short notice. Then what you're doing is you're saying that this type of money is being invested for a 1 to 3 month time horizon. And for such a time horizon, it is appropriate to be invested in liquid funds and overnight funds. The returns of these typically would be very much aligned to what the call money rates are, little over maybe the repo rate of the RBI. And therefore, that to expect like 4.5 to 5% is what would be reasonable for that time horizon. However, if you are thinking that, okay, I need this money, not in the next 1 to 3 months, but a little longer, maybe for 6 months to 9 months, then typically what we suggest is that you could look at liquid funds. You could also look at ultra short term funds or low duration funds. So these are typically also the funds where you will park your liquid money, which you are using to transfer into equity funds by way of a systematic transfer plan. Because this money is not 1 to 3 months, it's typically longer. So as I said, liquid, ultra short, and low duration funds. And then finally, you have investments in debt that you are putting aside for both short term and long term. And the difference in debt funds is that long term, from a tax point of view, is 3 years. So anything invested for less than 3 years will be short term for tax purposes. But you could invest for 2 years, 2.5 years as well, and you would have to look at your tax bracket. For such type of investments, you could move into short duration. You could also get into banking and PSU funds. You could think of high quality dynamic bond funds and the corporate bond fund categories. Like I mentioned right at the beginning, that corporate bond funds and the high quality dynamic bond funds, you have to be extremely careful to make sure that these are being invested with in high quality paper so that the chance of a default is less. And pretty much, I think this requires a seasoned advisor or a seasoned finance professional to look at this and to continuously watch and be in the market to be tracking these type of funds to ensure that you are taking really no risk at all. So I would suggest this would be the typical approach for clients when they are investing in debt for different time durations.
Okay, understood. You know what? As we speak, we've actually got some viewer queries that have already started coming in, for you, Mr. Navlakhi. But you know what? I'll just wait for one or two more queries to gather, and then we can take that. But in the meanwhile, at this juncture, I suppose, it's interesting that there have been some debt funds that have actually given a good amount of returns in the last, in FY20. Some have actually given almost 20 to 30% of returns. So it proves that equity is not king and asset diversification and allocation is extremely important. So Mr. Navlakhi, ideally, given the scenario at this juncture, how should one allocate their funds? Even if you are a long-term investor, should you put everything in equities? How much should you put in debt?
So I think at this point in time, with the situation in the market still being very uncertain, while we are happy today, it's a green day and things seem to have stabilized. We do believe that uncertainty will prevail for a while yet. It may take a few weeks, it may take a couple of months. But this is not a time to rush in and make your entries into the market. So if you're thinking of investing in equity, first you must choose where do you think the most likely place of recovery is going to be, and they will logically be the blue chips. Obviously, you have to look at the price, etc. But I think every blue chip has had a fairly large knock on the head in the last couple of months. And as a result, large cap equity is a good place to be. And therefore, you might think of deciding, if you are used to investing through a systematic transfer plan, that you will put some money aside and then systematically transfer money into this large cap equity fund. My suggestion would be to look at it over a 6-month period. And the reason why I say 6 months is not necessarily that I feel that it will take 6 months for things to recover, but it will only mean that if in the next month or month and a half, there are some opportunities available where markets do fall and you feel, okay, now is a good time to enter, then you can take some of that money which was scheduled to be transferred 4 months in the fourth, fifth, sixth month, take it and sort of advance it and transfer it into equity funds. On the most important thing, like I keep saying, is that at this point in time, maintaining liquidity for your next 6 to 9 months requirement is absolutely crucial. Having some cash on hand to invest if things get worse is also important. So I think both these things have to be taken into account before you decide, how much to put into equity and should I jump in? This is fantastic levels. It's up 30,000. I'll never get this opportunity again. I don't think this is a place where, it's a screaming buy that you need to rush in right now and with all the money that you have.
All right, fair enough. Now, very quickly, I want to, just take on board some viewer queries we've received. Our very first query is coming in from Ron Coutinho. He says, with the current global crisis in both equity and debt, which among the two would guarantee risk-free return vis-a-vis liquid or overnight funds? Yeah, please make a suggestion, accordingly. Mr. Navlakhi, how would you help out Ron with his query?
I think it's important that we all recognize that, putting everything in one asset class, in one fund, in one fund manager is the thing which is prone with the highest level of risk. Because if your selection goes wrong, everything and all your investments are in trouble. So the idea is to segregate. Like I mentioned earlier, I think for Ron, be clear as to what money you are investing for what period, and therefore then allocate. So if money is for 1 to 3 months, then liquid overnight funds are fine. If you are a little longer term debt investor, I don't want to take risk with equity. Then, as I mentioned, ultra short bond or low duration funds or liquid funds are good. We don't really know too much more of his profile, so I'm not going to venture into the answer into equity at this point. But if he's deciding to protect risk and that's the question, then I'm assuming he'd much rather be in debt at this point.
All right, fair enough. Let's take on board one more query from Mr. Madhav Kumar. He says, I have noticed a negative return in some of the ultra short-term funds, DSP, LNT and HDFC. I'm assuming these are the ultra short-term funds that he has. These were investments made thinking that there will not be any negative return. Is it that due to lockdown we are expecting defaults by corporates and hence that's the reason why these ultra short-term funds are giving a negative return? Fair point. Mr. Navlakhi, how would you clarify on Mr. Madhav's query?
Probably the data that he had, as of prior to last Friday. Many of these funds have recovered the negative, as we already spoke earlier in the show. And some of these debt funds, ultra short funds, have ended up giving a 0.8% return in the last week itself. So when I look at some of the ultra short term fund returns, they vary between 5 to 7.5% in the last 1 year. So I think some of that was a liquidity crisis, and I think RBI has acted now. So I think you might be in a relatively safer space for the time being. Offhand, I don't recall the holdings of each of these ultra short funds and the type of instruments they are in. So I would, suggest that there is a detailed review done before I say yes, go ahead with all three of them. If they do have something which is risky, then yes, you can get out of one of them and get into the other two. But I don't know it at this point.
Okay. All right. Well, folks, you have to also understand that we are living in precarious times. We don't know what the near future looks like, and hence, accordingly, you need to allocate yourselves in debt too. That was some advice that Mr. Navlakhi also gave our previous caller, viewer. Well, on that note, we're not going to be able to take any more queries. So thank you, Mr. Navlakhi, for joining in and sharing that very valuable advice.